No, I think the banking sector is very sick. It's not healthy at all. In fact, I think it has a terminal disease of government and Fed policy. I mean, I was warning about this crisis for years, just like I warned about the 2008 financial crisis for years. I could see this thing coming from a mile away.
In this intriguing analysis, financial expert Peter Schiff warns of a looming crisis in the banking sector. He asserts that the current state of the banks is far from healthy, attributing it to government policies and Federal Reserve actions. Schiff draws parallels to his past warnings about the 2008 financial crisis, emphasizing his foresight. He criticizes the widespread celebration of low interest rates, highlighting the downside for lenders, particularly banks. Schiff predicts a disaster for banks as interest rates rise, pointing to the postponement, not the cancellation, of a potential crisis. He unveils a temporary solution by the Fed, which involves replacing underwater collateral with cash, but cautions that the looming deadline could spell trouble for banks. With that, let's dive into the rest of the video to hear his full thesis.
Everybody was extolling the virtues of the 0% interest rates and the benefits that it had for borrowers. It was great. Americans could refinance their mortgages and get these rock bottom 30-year fixed rates, at 3%. Some people even got two handles on their 30-year mortgages. The government was able to finance all this debt at lower interest rates, and that kept the debt service costs down. So everybody was benefiting from the ability to lock in long-term debt at rock bottom rates. And I was one of the only people that I know of that was out there trying to point out the negative for the lender. Because what's good for the borrower isn't also good for the lender. If the borrowers are winning by locking in low rates, the lenders are losing at the same time because they're also locked in to low rates, only they're receiving the low rates. They're not paying the low rates. And so I was warning for years, what is going to happen to the holders of this debt, in particular, the banking system, when interest rates eventually rise? And you get to a situation where now money costs 5% and the banks have locked in their portfolios at 1%, 2%, 3%. I said this was going to be a disaster for the banks. And of course, that's exactly what it was. We got the beginning of what would have been a worse financial crisis than 2008 in March of last year. And that crisis wasn't canceled. It's just been postponed. The Fed was able to hold it in abeyance by announcing a program where the Fed would temporarily take all of that underwater collateral off the books of the banks and replace it with cash, 100 cents on the dollar. Mm-hmm. The catch was it only good for a year. At the end of the year, which is coming up this March, in theory, all those banks have to repay the Fed 100 cents on the dollar of what they borrowed, and they got to take their toxic paper back, which they obviously can't do because they would be bankrupt the minute it got back on their books, which is why they gave it to the Fed in the first place.
In this next discussion, Peter Schiff delves into the moral hazard created by government intervention in banking with deposit guarantees. He argues against FDIC, emphasizing that depositors should be aware of the risks they take when choosing a bank. The government's selective approach to bailing out banks based on their perceived significance has given big banks a competitive edge. Schiff predicts a trend where smaller banks struggle or get acquired, leading to an uneven playing field. He explores the impracticality of ensuring unlimited deposits and highlights the potential consequences of a major bank failure. As he points out the government's financial limitations, Schiff warns of a looming inflation tax if widespread bank failures occur, asserting that it's not a matter of if but when.
Eventually, there's a tremendous moral hazard here because of what the government has done with these deposit guarantees. I mean, we should have no FDIC. The public should know that you put your money at a bank, you're at risk. You're a creditor, and if that bank fails, you could lose your deposits. We need that for the public to be better customers when it comes to choosing a bank. But because of the government, nobody gives a damn which bank they put their money in, because it doesn't matter. Because if the bank fails, you're going to get your money back. Well, what happened, when we had that Silicon Valley failure and Signature Bank and a few others, the government let the public know that, it's not necessarily true. Your bank might fail, and you could lose money if you have more than the FDIC covered amount. But it depends, because if the government decides that the bank that you're with is somehow systemically important, then we're going to bail everybody out. But if we don't think the bank is significant enough, then we won't. And so what that did is it created a huge competitive advantage for the big banks, like JB Diamond's bank, all these big banks. Everybody knows, well, they're too big to fail. So there's no question that if I have my money with these big banks, I'm good. My deposits are going to be safe. But a lot of these smaller regional banks, kind of mom and pop banks, to the extent that they're mom and pop, but they're smaller banks, it's a question. And so why should I hold a large amount of money at a small bank when there's a risk that that small bank fails and I'm not protected? So I'm going to take my money out and I'm going to give it to these bigger banks. And this gives the big banks a competitive edge in the marketplace. And so what ends up happening is the small banks go out of business, or they get acquired by the bigger banks because they can't compete, because it's not a level playing field. The government has tilted it. Now, of course, the government could have said, look, we're going to insure every deposit up to an unlimited amount of money. But of course, the FDIC doesn't have the resources to do that. It doesn't even have the resources to insure the deposits that are currently insured. I mean, if a major bank failed, like a Bank of America or Wells Fargo, that would wipe out the FDIC all by itself. And so, the government would have to come and bail it out. But the government is broke. So where does the government get the money? It gets it from the Fed. But the Fed doesn't have any money until it prints it. But when the Fed prints the money, that just means inflation. That means that the Americans, or anybody who holds dollars, has to pay for that bailout because prices go up. That's what inflation is. It's a tax. It's the expansion of the money supply. And there would be a massive inflation tax if we had a lot of bank failures, which we will have. It's not a question of will banks fail. It's just a question of when.
Today, we've delved into the insightful analysis of Peter Schiff, who paints a concerning picture of the banking sector's health and the potential risks it faces. From warnings about government policies and the 0% interest rate era to the looming challenges for smaller banks, Schiff leaves us pondering the future implications for the financial landscape. As we navigate these complex financial discussions, it's crucial to stay informed. If you found this analysis valuable, don't forget to subscribe, like, and hit the notification bell to stay updated on our latest finance insights. Your thoughts are essential to us, so share your opinions in the comments below.